My friend Doug Casey described the U.S. dollar as the worst currency in the world, with the sole exception of all of the others. Uh, the U.S. dollar, for all its fault, is the most liquid currency in the world,
Right.
and it's also the most transparent, the least opaque currency in the world. It is a currency where most of the international debt in the world is denominated, which means
Yep.
that demand for dollars to pay back debt, irrespective of Mr. Trump's popularity or lack thereof, is very high. No other currency has that.
Yeah.
Uh, the last time I looked, about 2.5% of the world's international obligations were denominated in renminbi. So what do you think the relative demand for debt service between renminbi and US dollars are? This one's fairly simple. As absolutely ugly as the numbers around the US dollar are, as ugly as they are, paradoxically, they're uglier in other places.
Yeah.
And when people get very concerned about their liquidity, about the sanctity of their liquidity, the global demand for US dollars in the past 4 weeks has gone absolutely crazy, including by countries that already have too many of them. Now, I think this is a fairly short-term phenomenon. Let me rephrase that. I think the US dollar over 10 years will do relatively well against other currencies. I think the US dollar over 10 years absolutely, that is not compared to the Canadian dollar or the euro, will do extremely well. Extremely poorly. I think that the purchasing power of the US dollar in isolation will fall by 75% in purchasing power, which means that a basket of goods and services that cost you $1,000 today will cost you $4,000 10 years from now.
Yeah.
I lived through that in the decade of the 70s. The purchasing power of the US dollar in that decade fell by 75%. Not coincidentally, Craig, the gold price ran 26-fold.
Not coincidentally. That's
That
right.
isn't to suggest it's going to run 26-fold from here, but I would ask your listeners to consider the probability, I think, that gold maintains its purchasing power.
Yeah.
Which means that the nominal gold price in US dollars, should mirror the decline in the purchasing power of the US dollar, arithmetically.
Correct.
Maybe it isn't 4-to-1. Maybe it's 3. Maybe the gold price only doubles in 10 years. You get the point.
Right.
You own gold defensively. If you have the courage, you invest in gold stocks, taking the company risk around the price trend in gold. If you really have guts, you speculate on the gold side. You do it predicated on the probability of stronger nominal gold and silver prices.
Well, if let me go off into the miners, because that was the other thing I wanted to ask you about. Since all of this began 2 weeks ago, the GDX is down something like 16, 17%, the big ETF. And a lot of the big mining shares have come off a little more or less than that. So you look at that and you think, as an investor in the mining shares, you think, well, okay, well, look, we're almost entirely through the first quarter. And the earnings in the fourth quarter are fantastic. And the metals price in the first quarter are going to be even better. But these shares are getting dumped significantly. Is it a function? Are people reading? I mean, I know energy is the biggest input cost in mining, right? So are people reading too much into this higher energy cost thing affecting margins? Or is it just, again, another inefficient overreaction?
Absolutely narrative. I think people are being stupid.
That wouldn't be the first time.
I think most people don't do any work, though.
People
pay slavish attention to price levels, and people pay slavish attentions to stupidly short periods of time.
Yeah.
And people say that the GDX is down by 16%. No, it's not. It's up by 100.
Well, that's true.
It just depends on your time frame.
Yeah, where you start.
If you segregate between price and value, when I look at the major mining companies and I do net asset value calculations, including their development pipelines and their cost of capital, at $5,200 gold, I get a markedly higher number than the enterprise value of these companies today. People say that these companies are trading at 1.2, 1.3 times NAV, but they do that based on consensus metal pricing. at $3,200 or $3,300 gold.
Right.
If your earnings are calculated on a $3,300 basis and you're selling your material for $5,200, it's going to be very tough not to yield a positive earnings surprise. Now, for me, I have a very full portfolio of the big guys, a very full portfolio. And I hope they go down in price so I can buy more. I am unlikely to sell my gold stocks, my big gold stocks, my really good gold stocks, even my best juniors, anytime soon. The consequence of that is, given that I'm not going to sell, I would prefer to buy. And obviously, I would prefer to buy stuff that was cheaper as opposed to more expensive. I realize that many of your listeners don't have the courage born of knowledge that I have. And many of them probably have different financial circumstances. But if you have a good enough sense of a company that what you would like to see is lower in price, then you probably know enough to invest.
Are there other commodities you're kind of interested in here as we get into 2026? You and I have been talking about uranium for years. Yeah. Are there others on your mind?
Uranium, I'm very full. I need to say that. Uranium's another one where I would love to see the stocks cheaper,
pullback,
opposed to more expensive. But that's not going to happen. This is going to be a good year for uranium stocks for a couple reasons. I wasn't able to go to the World Nuclear Association meetings in London. Too busy in retirement. But I was able to listen to about 60% of the recordings, and I was struck by a couple things there. The first thing I was struck with was there was odd consensus on the dais that the global above-ground finished inventories were 200 or so million pounds. I don't know how to get those numbers, so I don't know if they're true or not. But the point was made that with a supply deficit of 30 million pounds and above-ground finished inventories of 200 million pounds, that we had 6 years to get through inventories before we had to catch up.
Yeah.
That completely neglected the fact that if that 200 million pound number is right, Sprott owns 82 million of them.
Right. That's
just not available for sale.
Right.
That cuts the available for sale estimate by 40%.
Yeah.
That becomes salient. The second thing that I noticed, and I'd seen this myself, was that for 15 years, the utilities had availed themselves of the spot market for material because it was cheap and it was liquid. But the spot market isn't liquid anymore. Most days that I look, the Sprott Physical Uranium Trust trades between 2 and 4 times the dollar volume of the spot market, which is to say the Sprott market has become the spot market. The companies that have relied on the spot market for product can't rely on it anymore, and that's come to be reflected in the term market. In the term market, near-term delivery, 2026 delivery, is as much as $8 a pound higher than the spot market. What that means is that the utilities have become concerned enough about supply that they are willing to pay more in the near term to lock in their supplies in the long term.
Yeah.
And this is extremely bullish.
Yeah.
Extremely bullish. The third thing that's bullish, you and I have talked about in the past, but for the benefit of those few listeners on today's calls that haven't slavishly listened to our prior conversation.
Yeah.
The structure of the uranium market is changing from the spot to the term market, unlike any other commodity in the world. The significance of that is that uranium producers know with some certainty, provided that they have a credit grade counterparty, a utility, not a trader, what they're going to receive for their product and how much they can sell. And that means that doing cash flow forecasting, whether you're a provider of equity or a provider of debt, is much more certain. And this will lower the cost of capital to the uranium sector, and it will increase the availability of this sector. Let's look at Lee Courier at NextGen. There's no way in the world that Lee, with his balance sheet, albeit a good but small balance sheet, could independently, on balance sheet, finance the construction of their Saskatchewan project, arguably the best undeveloped uranium project in the world. It's just too big, and they're too small. But if Lee can go to Ontario Power, Duke Power, Southern Companies, Tokyo Electric Power, China General Nuclear, a bunch of investment grade counterparties with contracts, and then take those contracts to the bank, particularly if he can do a turnkey build on that project, fixed price turnkey build with Westinghouse Cameco, a project that he couldn't finance before on his balance sheet becomes financeable. It doesn't mean that he will do it. It just means that if Cameco comes into him, or Anglo-Tech comes into him, or BHP comes into him and says, you should sell us this because you can't build it, he can say, well, you might be able to buy it, but I can build it. So your price better reflect the fact that I can build it. And that's a huge, huge, huge change. The next gens of the world, the paladins of the world, the yellow cakes of the world, will be able to build their projects if they choose to, because the migration of the market from volatile spot to fixed price long-term contracts suddenly makes these things much more financially viable.
You've got me thinking price maker versus price taker in that
That might be
situation.
aggressive, but there's zero doubt we're seeing in the market now, and this is actually a related topic. I probably told your audience more than they want to know about uranium. But if somebody goes out to build a nuclear power plant today, a big one, I'm not talking about one of these little firecracker,
Right.
wrong phrase, SMRs. The banks, which are putting up 60 or 70% of the construction costs, are increasingly requiring the builder to obtain enough uranium over time to amortize the loan, which is to say they are requiring China General Nuclear, as an example, to obtain 20 years of supply to amortize the loan. The availability of that in the contract market is what is really driving the availability of the producers to secure these type of agreements. It isn't just the producers that need these contracts. The consumers need the contracts too.
I hadn't thought about that, Rick. If you were going to finance that, I'd want to make sure, if I was loaning the money, I'd want to make sure this.
But Craig, as you know, I've been a lender for a very long time, and it's really refreshing if you can see how you're going to get paid back.
Yeah. Which, and if your primary product is going to be power, you better show me a way that you can generate it.
Yep.
Fascinating. You and I have been. You first started telling me about uranium at least 4 or 5 years ago,
right?
6 or 7 maybe. And in my diverse portfolio, I've probably got about 10% uranium, and it's served me very well.
I think you're gonna have a good year.
I think so. I'm already having a good. Yeah, I think so.
I don't think that these stocks are cheap based on the uranium price.
Right.
I think these stocks are very cheap relative to what I see the term market doing over 5 years.
Where do you think
and
it's
relative
going?
to the fact that their cost of capital is going to come down.
Yeah. And that point you made, Rick, who knows where they came up with the 200 million ounces, but 40% of it is tied up in that Sprott fund. You would think that's included in the 200 million.
I've been trying myself, admittedly, the president of Kazakhstan doesn't have me on his speed dial, but I've been trying to ascertain for my own purposes what above ground inventories have been for 30 years. And I've been consistently unsuccessful. I've gone to industry conferences. I've, bought bottles of wine for Itochu and the other traders. I don't know.
Well, and Rick, your old mantra is, higher prices or high prices are the cure for high prices, right?
Yep.
But this is not necessarily that direct of a process.
Well, it takes time for that to work out. It does. I've said in capital intensive industries, the cure for high prices is high prices and time.
Right. This sounds like the higher
I would argue on an inflation adjusted basis that the prices that we're seeing for uranium aren't particularly high. I would also suggest for uranium and a few other substances too, platinum among them, that the utility to users is so high that demand becomes, for a time, price inelastic.
Yeah.
It turns out that at $80 a pound, fuel comprises about 5% of the operating budget of a nuclear power plant. Somewhere right around legal and compliance. Cost of capital and taxes, social rents, are the big changers. What that means is if Craig and Rick have built Craig and Rick's great reactor, we've somehow raised $8 billion, and we built a reactor, and we need 1 million pounds of uranium a year for this reactor. Remember, we have $8 billion into the reactor. If the price of uranium goes from $80 a pound to $150 a pound, we don't conserve.
Right.
It actually, a doubling of the price of uranium almost doesn't change the cost of producing the fuel. If the fuel is less than 5% and the price doubles, that's a 2.5% change in the inputs.
Yeah.
It's irrelevant.
And again, it's not like you can go without.
Right.
That's the other part of it.
Yep.